Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thanks for joining us to learn about portfolio hedging using S&P/TSX 60 Index Mini Futures trading under the symbol SXM. An investor may hold a diversified portfolio of Canadian securities and would like to reduce market exposure due to short-term risk concerns. The investor could simply choose to close positions held within the portfolio. However, there are several considerations in doing so, including foregoing dividend income, incurring transaction costs, as well as tax implications. As an alternative, SXM futures can be used to hedge a portfolio that has a strong correlation to the S&P/TSX 60 index. This solution will allow the investor to maintain all of the existing positions in the portfolio without the aforementioned obstacles. To accomplish the hedge, SXM futures contracts must be sold short. Let's assume that an investor has an equity portfolio worth 500,000 Canadian dollars and would like to reduce market exposure by 50% or $250,000. In this example, we will assume that the S&P/TSX 60 index is trading at 790. In order to determine the number of SXM contracts to use, the beta of the portfolio must be determined. Portfolio beta reflects the variance in the portfolio value as it compares to the overall market. A beta of 1 represents the market. Therefore, a portfolio with a beta of 1 will move with the market. On the other hand, a portfolio with a beta greater than 1 indicates that it is more volatile than the overall market. Conversely, a beta less than 1 indicates that the portfolio value is less volatile than the overall market. This table reflects a typical diversified portfolio. Note that the weighting of each security is multiplied by its unique beta, and the average beta of the portfolio is then calculated. In this example, the average beta of the portfolio is 1.36. To determine the number of SXM futures contracts required, the portfolio exposure is multiplied by the beta and then divided by the value of the SXM futures contract. The investor wishes to hedge 50% of the portfolio's exposure. With the portfolio valued at $500,000, $250,000 is multiplied by the beta of 1.36, arriving at a figure of $340,000. The index value of 790 is multiplied by the SXM point value of $50 to arrive at a contract value of $39,500. $340,000 is then divided by the index value of $39,500 to arrive at a figure of 8.6075. As a result, the hedger must sell short 8 or 9 contracts to reduce the portfolio's exposure to the market by approximately 50%. This table reflects the net result of the hedge. Notice that as the market appreciates, a portion of the profit is offset by the depreciation in the SXM futures. However, as the portfolio loses value with a market decrease, the SXM futures have offset approximately 50% of the losses. To summarize, by using SXM futures as a hedge, the investor has reduced exposure to the market without having to close any of the positions. During that time frame, dividends were still collected, the investor incurred minimum transaction costs, and there was no tax disposition of the underlying investments.